You found the perfect property. After submitting your first letter of intent and some negotiations, your offer has finally been accepted by the seller. Then, after a few weeks into the due diligence period, you approach your trusted banker. He offers you a loan with a rate that is below the market, but there's a catch. This loan cannot be assigned to a third party in the future. In an environment with rising interest rates, that may make the difference between a high cap rate and one that allows you to sell the property for a profit. In this video, I'm gonna teach you 7 provisions you must watch out when shopping for a commercial mortgage. So stay tuned to find out. Okay, the first thing you have to know when shopping for commercial real estate mortgage, it's not the same thing as residential mortgage. You probably have purchased your first home or second home, and all you have to watch out there maybe it's the interest rate, because the other things are usually standard. But in commercial real estate there are many other things you have to pay attention to in order to have a good deal. So the first, it's pretty the same as residential and as pretty standard, interest rate. Okay, so but anyway, you have to find out, you have to negotiate a good interest rate. Okay, so you have to compare some other loans, and usually commercial interest rates are in line with the Fed rates. Okay, so if the Fed rates are, for example, 6%, you will find on commercial 8% or 2 or 3 points above the Fed rates. Okay, so this is the first one. The second, the same thing, it's pretty standard, but there's one thing that is different here for commercial loans than residential loans, because usually in residential loans the term of the loan and the amortization period are the same, usually are 30 years. Okay, so that means you will pay off all the loan on the 30 years and you will amortize that capital all over the 30 years. But in commercial, these are different concepts, because may be the case that the term of the loan it's 10 years. Usually in commercial it's 5 to 10 years for an investment, for a long-term loan, and the amortization may be 30 years. So that means you will be paying 30% of the capital, so 10 divided by 30, so that means you will be paying the third part of the capital, and at the end of the term of the loan you are having a balloon payment. Okay, so because the term, it's the amortization, it's longer than the term. Okay, so you are having a balloon payment. So usually, as I already told you, for commercial it's the term, it's 5 to maybe 7 or 10 years, and the amortization is usually 20 to 30 years. Okay, and also there are many loans in commercial real estate that there are interest only. So that means those are not amortized. It's 5 years, let's say. So that means the balloon payment at the end of the term will be the full amount of the capital for that loan. The third clause you have to watch out, it's if the mortgage it's a recourse loan or non-recourse loan. What that means? That means if you, for a recourse loan, it's the same as residential loans. If you don't pay your residential loan, the loan for your house, they go after you. Okay, they go after you, and if they foreclose your home and you still have to pay the bank, if you still have to owe the bank, then they go after your assets, maybe another home or your salary or some other things. So that's a recourse loan. So usually because commercial loans are big loans, are millions of dollars, so usually for these loans are non-recourse loans. But not all. For agency loans, for example, in multifamily, they are usually non-recourse loans because these are millions. Okay, so that means if you don't pay the loan, the bank will just foreclose the property, but will not go after you. Okay, so but for small banks, for small community banks, usually they use recourse loans. Okay, so if you don't pay for the property, for the mortgage, then they go after you. So you have to watch out if the loan is recourse or non-recourse. Okay, so the fourth thing is assumability. What does that mean? Okay, usually investors think assumability has to do with the bank, if they can sell the loan. That's not the thing. This is for the person that owes the bank. Okay, so if you have assumable loan, that means you can sell, or you can, for example, if you sell that property, the new buyer of the property can assume that loan. Okay, so this is good thing if when you purchase the property and got the loan, you have a low interest rate. Okay, so that means if you sell the property, let's say the property costs you 1 million. Okay, so and the interest rate was 3%, let's say, and now you want to sell the property, and the interest rates out there are, instead of 3%, they are 6%, let's say. Okay, so you still have that 3% loan. Okay, so because the loan is assumable, that means you can sell your property for much more. Okay, because the new buyer will be paying lower interest rates. Okay, if they go shopping another loan for another bank, it will cost double the rate, 6%. So that means you can sell your property for more. Okay, so that is a good thing when you are shopping for commercial real estate loans. Okay, so the 5 point is the early payments. Okay, so usually not all commercial loans let you to do early payments, as is the case in the residential loans. Okay, if you have a house, maybe you let's say you win the lottery and you can pay down all the loan, all the mortgage. But that is not always the case for commercial real estate. They may charge you a fee if you want to pay off all the loan. Okay, so you have to watch out for the early payments clause. Okay, that they don't charge you a fee when trying to pay off the loan. Okay, so the sixth point is the collateral or loan to value. Okay, so collateral is the guarantee of the loan. Usually this is the property. Okay, so if this is the property, you have this number that you may already know, that is the loan to value. Then usually for commercial loans, the banks lend up to 80% loan to value. Okay, but there are other kind of loans that are called cross-collateralized. Okay, so that means you can add another property to the collateral, so you can increase this number, the loan to value, so that way they will loan you more. Okay, so this is another important thing. And the last thing is the extension options. Okay, so this is more important for example, construction loans or bridge loans, when you are trying to add some value to the property, to sell it out or to refinance. Maybe you got 2-year bridge loan. Okay, you were expecting to rent and stabilize the property in 2 years, but maybe things are not that good and you you take 3 years instead of 2 years to stabilize the property. So with an extension option, you can ask and execute an extension option, and then you get the 3rd year and you have enough time to stabilize the property. Or maybe in a construction, the same thing. Maybe you have a construction and you were expecting the construction to take 2 years or 1 year, and you have to execute an extension options for an extra 1 year, and then you have enough time to then refinance with a long-term loan. Okay, so in the next whiteboard, I'm gonna show you with an example how these clauses look like. Okay, so now let's see an example of how a property with 2 different loans with different clauses would look like. Okay, so here we have 2 loans for a 1 million warehouse. The holding period for this warehouse is 3 years. So we are purchasing a property, holding 3 years, and then sell it after the holding period. So the entry cap rate is 7%. That means 3 years NOI will be $210,000. Okay, so for the loan one, it is lower interest rate. It's a 4%. Okay, but this is a recourse loan. So that means if we don't pay the loan, the bank go after us. Okay, so then this one it's non-assumable. So that means even it's lower interest rate, when we sell the property, we cannot pass the loan. So the new buyer assume the loan. Okay, so the interest paid for this loan will be $120,000. So the exit cap rate would be higher because it's non-assumable. That means we have to, usually we purchase a property, when we sell it, the cap rate would be higher. That's natural thing. This is not an anomaly. This is a natural thing. So we can expect the cap rate to be higher. So that means the sale value it's a little bit lower than the purchase value. So the real cost will be the interest, which is 120, and the 41 will lose from the value of the property. So that's something to compare the 2 loans, because we lost the value of the property. So the real cost will be $161,000. Okay, for this loan. And then we have the second loan, which is 6%. Okay, it's a little bit higher, but this is a non-recourse loan. So that means less risk for us, because if we don't pay for any reason, the bank will not go after our assets. So this is also assumable. The interest paid for this, it's, of course, it will be higher. It will be $180,000. But the exit cap rate will be lower. Why? Because let's say in this situation, even if this is higher than this, the interest rate, 3 years after, the interest rate went to 8%, let's say. So we still have a lower interest rates than the market. So that makes our property more attractive for investors. So that means we can charge more because we are selling the property, but we are also selling the loan. You know what I mean? Because it is assumable. So that makes the cap rate to compress. Okay, and that means more money in our pockets. So sale value will be higher than the purchase value, which is 1 million. Okay, so that means we have here a profit of $77,000. Okay, so the real cost of the loan will be the $180,000 we pay for the interest rate, less the appreciation we have in the property. So we had 180 less 77, so we have a real cost for here for 103,000. So that when we can compare this loan with this one, and then we can decide which one it's better. You see, here with a lower interest rate, we have a cost of 161,000, and here with a higher interest rate, we have a lower cost of 103,000 because this one is assumable. In this video, I teach you 7 numbers to watch out when purchasing for a commercial real estate loan. So what other numbers do you think we have to watch out when we are purchasing for a commercial loan? Write it on the comments. So thank you for watching the full video. I guess you like it because you reached this point. So if you like it, please give me a thumbs up. Really helps me a lot. And if you want to keep receiving these videos and getting a notification every time I load a new one, hit the subscribe button. That way you will be updated every time I load a new video. If you want to invest in commercial real estate, but maybe you don't have the time or the money to start in, you can join my exclusive investor club. My investors start investing from $20,000, and the best part of it, it's totally stress-free. I manage everything. You can join by clicking on the link on the description below, and that way you will receive an email every time I find an investment opportunity for you. Thank you for reaching this point. I see you on the next one. But first, I will leave you with 2 more videos here.